Cryptocurrencies have drawn in millions who seek to capitalize on its sudden and massive success, especially during its bull market back in 2021, where billions of income were generated, which in turn made thousands of millionaires in a relatively short amount of time. Those who were lucky enough to gain from its rise shared their success stories online, which dominoed into more aspiring investors to engage in cryptocurrencies. But unlike any market, digital or otherwise, there are also setbacks and not all stories lead to a happy ending. The crypto world has been plagued by issues ranging from security breaches with millions in dollars in damages to large-scale frauds that cost the market billions, not to mention the already fragile trust of investors and would-be investors of the cryptoverse. Welcome to our channel, where we show you all the latest, relevant, and any information that has to do or affects the world of cryptocurrencies, all in the market of your very own Crypto Addict. Today, we'll be looking into the crypto value affecting variables that cause the rise and fall of cryptocurrencies across the spectrum. Before anything else though, please remember that this video is not any form of financial advice but solely our fact-based opinion that is meant to educate and inform you of the latest and most relevant information fresh from the world of cryptocurrencies. We strongly urge you to do your own research first before dealing, trading, or buying any cryptocurrencies, because knowledge is your greatest asset, so invest in it first. Before going to the different variables, it's important to know that one of the major reasons that many, if not all of the 13,000 cryptocurrencies that are currently available in the market aren't backed by any central agencies such as banks, since the real and initial goal of cryptocurrencies was decentralization. Now, let's get into the many variables that affect the rise and fall of crypto value in the market. First one is supply and demand. Like many major assets in both the online and physical world, cryptocurrencies are affected by the supply and demand. The more demand, coupled with a limited supply, increases the price of a coin, while the lower the demand and greater supply will pull crypto's prices down. Let's use some major coins as an example. Bitcoin has a limited number of coins that can be minted to just 21 million coins. Binance Coin has a limited supply of 200 million coins, and Ripple will only be limited to 100 billion coins. Now, these figures might seem to be a lot, but considering that the average number of $100 bills printed in the last 10 years exceeds 1.5 billion bills per year, it's logical to think that the limited supply of these coins would ultimately cause their values to rise. There are even governing bodies and agreements between crypto companies, such as mergers, that may decide to mint more or even burn coins in order to facilitate the supply and demand for their coins. Demand may also rise when a currency's popularity or utility rises, particularly if it starts to be considered as an investment. Cryptocurrency exchanges. Sure, there are thousands of cryptocurrencies in the market, but only a few crypto exchanges list the smaller or lesser-known coins. These crypto exchanges usually list the major cryptocurrencies in the market, though they seldom cater to smaller coins, making access to these coins harder for investors. Because of this, the rate of investing goes up when wallet services collect quotes from various exchanges to trade a certain group of coins. Naturally, if a crypto with an already low following trades poorly on an exchange that caters to it, the exchange might ask for a larger fee that may be too much for investors. And given that investing in a lesser-known crypto on a volatile market is already too much of a risk in and of itself, investors might opt to just look for more established coins with significantly lower risks. Consequently, if these cryptocurrencies manage to get listed by more exchanges, it can increase the chances of it being traded by investors, as it increases its exposure and ease of access. Its price would then increase too. Competition. Competition is everywhere, and nowhere else is it more apparent than the cryptoverse. As I mentioned earlier, there are thousands upon thousands of cryptocurrencies, as it is relatively easy to start building one and launching it for the public. There are a multitude of ways that cryptos could differ from each other, but it's undeniable that one of their major goals is to be traded and invested upon by crypto enthusiasts, and really just anyone who's willing to invest and looking for good returns. The challenge, however, is making them viable. And in order to even come close to becoming viable, cryptocurrencies must establish a strong network of partners and users and form some level of utility. If a crypto offers an application on and off the digital world, the quicker it is to establish that network, especially if that use is exclusive to the said crypto. This would increase its trade prices, as more trade traffic would result from its utility. However, if competitors manage to imitate or even create a better version of what it currently offers, then it might just lose its value altogether. Key to success in this fast-paced and volatile market is speed and adaptability. If a coin lacks any of the two, then it's destined to perish. Internal governance. Let's face it, there's no real governance or even just a consensus of one that oversees cryptocurrency operations. So long as it's not a fraud or some sort of scheme to fish money out of the ignorant investors' pockets, then developers are basically free to do what they want. The only real guard to their actions are its users and investors' even keener eyes, guarding for any bit of data that could ruin their investments. Most crypto developers even base their policies on the community that invests and follows them. Though there is some sort of agreement that needs to be met between investors and major stakeholders, some crypto developers even let their community decide some of their policies. In the world of investing, the more stable the internal governance of an asset, the more stable its prices will become. So, that's definitely one aspect of crypto that developers must master. The current slowing of processes and updates on many of the cryptocurrencies during this bear market definitely affects the overall trade performance of a coin, hurting these stakeholders' wallets. Regulation. If there is governance, then there must be regulations and policies set in place to better improve and provide stability to the whole of the crypto community. Because of the way cryptocurrencies were developed and the uniqueness of the trade, governments setting up regulations to facilitate the trade of cryptocurrencies are scarce. This inability of world governments or any sort of governing bodies to facilitate the trade of cryptocurrencies adds to the volatility of the market. This is both good and bad, as there are no current limits to how large your gains could be investing in crypto, and consequently, there are no limits to your losses as well. And sometimes, the risk for trading on a crypto is greater than any prospective gains it could give. As traders or would-be traders, what sort of policies and regulations would you like for the government or a governing body to enact this year? Let us know in the comment section below and make your voice be heard together with all the like-minded individuals hoping to make a change starting here in your very own Crypto Attic. Node count. Node counts are ways for investors to know the number of active wallets on a given network to basically know if the community that a cryptocurrency belongs to is actually viable. This is somehow similar to the crypto exchange factor. The more crypto wallets involved in a community, the better traffic there is for a cryptocurrency, which translates to it being more stable and viable. And the lesser number of wallets in a given community simply means that the results are unsatisfactory, threatening the downfall of a crypto. Last but not the least, social media. Social media has become an essential part of human lives in this current modern age we're at. It is more so in the digital world, where every bit of news or updates for a single cryptocurrency could affect not just itself, but other cryptocurrencies across the board as well. There are even market pumps that are solely due to social media hype watched by ignorant people. This is why we encourage you to do some research of your own kind before investing in any kind of cryptocurrency you want to start trading with. Knowledge is your only shield against unfavorable situations. That's all for today. Make sure to leave a like on our video and follow our channel for more relevant content about the cryptoverse all in the comfort of your very own Crypto Attic.